traded fund, changes in your low-cost brokerage account, whether it be regular account or IRA or whatever that you make based upon the signal we send you. We have a portfolio, a handful of different strategies that have held up really well in the market, in real life trading. And this adds value versus buy and hold. This does not guarantee you're going to make money, does not guarantee that it's going to beat the market, but it has a very good track record of either or both reducing the risk and volatility and drawdowns of the market, and often having a better return than the market. And it does that by the way they blend assets together, the way it rebalances monthly, and when it shifts into more risk versus lower risk in different cycles. One last thing, and I'll pass it to Alex. We also have a layer that is now built but not quite released to you yet into what we call meta strategies that take each of these strategies as building blocks and then blend them together. And that has some extra benefits, but it's the same principles. As you blend these things together, it tends to reduce volatility and usually improves return versus what the market offers to you. And at a high level, it's that simple. Thoughts, Alex?
Yeah, maybe diving in a little bit. Again, we had the opportunity to present some of our stuff at the AI in San Jose, California, 2 weeks ago. And obviously, we said we also want to give the same opportunity of interacting and discussing and raising questions with the followers from Logical Invest. So again, this is one of the main intents today. Scott, maybe if you go to the next slide, so we can just see the topics. Again, the topics we touched on there is a little bit more background on who we are, what we stand for, what we're doing and why we're doing it. And then we had 4 functional topics really. The first rather entry level, how to build up your self-managed portfolio out of our view, how we're doing it by ourselves. Then talking a little bit more on the crash protection, which again is one of the very fundamental things we're doing. And again, we're doing it slightly different than other of the blogs, vendors out there. So this might also be a topic for today to touch on. Topic number 4 really is then, let's say, hardcore, very advanced stuff, at least in the theoretical level, how we derive that. It's not so difficult to implement actually, but this might also be something which we can touch on. And then it's just Scott just highlighted the last topic, which again is a little bit a teaser. Markowitz meets Logical Invest is very much focused on what actually our strategy look like on a classical risk return plot, and how the different features we are offering fit in there, so you can build up your own portfolio. So maybe just using this slide also, if you could just either tell or type in also if you're interested really in one specific topic, which we can then use a little bit more time on, and so we don't have to go through the whole slide, and rather go where your interest is. And everybody's unmuted, so feel free to speak up, or just use the comment or the question tab to type in a little bit.
Thanks, Alex. So let's jump in and either call out, comment, chat, or type in questions. Love to hear from you. think about this as more like a talk radio call-in.
I know, for example, Michael yesterday was interested in the meta strategy, so this is something we can go in.
Yep, good. Well, let's just we'll give it one more minute to see if anybody else wants to call out, and if not, we'll jump in that direction.
Phil and Stephen I also recognize by name. Mark, Jason, sorry if I missed you. So guys, now this is up to you.
So what makes sense, and probably more importantly, what doesn't make sense? What feels comfortable, what doesn't feel comfortable? Okay, somebody has to be first. All right, Michael, I'm going to put you on the spot. Say something.
I'll give it a try. Can you hear me?
Thank you, Mark.
Yeah, one of the reasons I wanted to get on the phone with you today is I'm fairly new to Logical Invest. I've been with you for a couple of months. I had some questions about just the basic strategies. I'd like to kind of understand better about the lookbacks and whether they're adaptive or not. I'd like to understand with the new strategies based on the Sharpe ratio if there's still a switch to cash, and if so, how that occurs. And then I'd really like to dig into that Markowitz and how to blend the different strategies and what your strategies and what your thoughts are for picking and then allocating funds between the different strategies based on the Markowitz methodology.
Good.
So that's kind of what I was thinking
thoughts.
and hoping to get out of today.
Excellent. Well, why don't we just jump right into that? So on the adaptive, there's a number of elements that are adaptive. The look back at this time is not adaptive. We have built adaptive look backs. Understand the concept. It's not crazy. Under certain circumstances, it works. In this particular construct, due to the way our algo is working, we have not at this time found a need or particular, value in having the look back be adaptive, but it's a smart question, and at some point there may be other variations of things we're doing, particularly those that are more that are playing off of much more short-term and mean reversion, or like sometimes individual stocks and things. I personally found, and I'll let Alex jump in, where adaptive look backs, and just for the rest of the audience, what that means is, the models tend to learn from the past. They go back, 6 months, they go back a year, they go back, handful of months, and they're learning. And so the question is, do we have that? Do we allow the model, or do we push the model to change how long it's looking back? And so we have tested that, and we found with these somewhat longer term perspectives that having that be adaptive, and again, just because something is adaptive doesn't mean it always adds value, right? Sometimes, that's why the process is very, very delicate. And you got to make sure that you're doing more good than harm, and just because it has a better back test doesn't mean it's more reliable and robust. So
you've published some Sharpe ratios based on look back.
Yes.
So and I'd understood that what you were doing was selecting the look back with the best Sharpe ratio period to period.
Correct.
Is that not correct?
I mean, generally, yes. I mean, the process of picking a parameter is very delicate. What you're not going to, you don't want to pick the highest point of that parameter. What you're looking for is a stable plateau. What that means is you're looking for stability in results, and you look for stability in results due to different combinations. In particular, you're looking for stability over time. So, yeah, on a simplistic basis, are we picking what works generally best? Yes, but best practice is not to pick that parameter, whether it be look back or any other parameter that is the best in terms of CAR or Sharpe. You're picking that which is stable and reliable, because it's all about being robust and stable out of sample and going forward. Does that make sense? Because, for example, think of it like a topography, a mountain range, whatever, right? You don't want to go for the peak, because the peak is unstable.
Right, right. So you're looking for a plateau.
Yes. And you can look at that plateau on a couple different dimensions. It's very subtle, and there's art as well as science. Generally you want to look for the plateau both in terms of parameter sets and time, because you could have a certain time period, let's say 2008, like, wow, it just blew it out of the water with that particular approach in 2008, and it just throws the whole thing off. Not saying you ignore 2008, but you don't let it dominate the model.
Maybe let me actually, because we can show you how this works actually in practice. So let me just try to share the screen quickly. Can everybody see my screen now? This is the most recent article here, what was named the Hell on Fire version for the 3 times leverage universal investment strategy. And in that article, I also included this chart here, which you can see there. This is what we call a parameter robustness heat map. And this is actually what Mark was referring to. So, for example, the underlying algo of the universal investment strategy, again, optimizes for maximum Sharpe. We're looking for the pair and the allocation between 0 and 100%, which gives us the best or the highest Sharpe ratio. Yeah. As Scott mentioned, we are not using in the backtest, we are not adapting the look-back period at each individual month. That is kind of fixed, but we're using what is called a walk-forward mechanism, which I explained a little bit more in the video also to the AI guys, which means basically each year, once a year, we redo the backtest and check if in the recent history of 1 year there was a change in the market which would cause this parameter of look-back to adapt. Yeah, so it's a highly complicated process, and one of the things we are keeping a little bit more insight. But what it does basically, it gives you this outcome. For any look-back period, which here is 47 days to 69 days, and any of the what we call maximum modified Sharpe ratio, which the formula is also published on our website. What's the outcome? What are the different Sharpe ratios if you plot them on that matrix? And you can see here there's a fairly stable dark green range over the different what we call F factor, the adjustment factor, and also fairly stable over the different look-back periods. Yeah, Mark, and this is going to your point. So yes, we're looking for the best Sharpe ratio, but we make sure that we're not getting into a corner solution where, for example, we would select a parameter up here, which is then very only at that specific look back does this algorithm work. So we make sure we are somewhere in a green range which is stable over a broader range of the parameter. And you can see that here, this is for Sharpe. The next here is the maximum return. And the last one is actually for the volatility. Yeah. I think that was the first part of your question. And the second part of your question was right. Is cash?
Yep. So the answer on cash is right now, most of the models do not go to cash. We have actually found it generally better to use assets that are either, normally anti-correlated with the base, and you could get that with treasuries sometimes. You can get it with some inverse volatility, some volatility things, different ways to get there. We find that the shifting asset types during times of stress and fear, etc., actually does normally a better job than cash. However, that's not to say that whether it be down the road or what you should be doing is always be 100%, or some people 200% invested, right? So we are operating on the premise that you, the investor, are doing what I'll call the first level risk management, which is to say that which you put into our strategies, while we are doing the best we know how to reduce the market risk, you are putting anytime you're putting anything in the market, whether it be commodities, whether it be bonds, whether it be equities, whatever it is, it is a risk asset. And so what we're doing is by shifting in these particular strategies the mix, we would greatly reduce the volatility, etc., and reduce the drawdowns. Some of the more advanced things that we're looking at right now do have some cash shifts at the total portfolio management level, and so there was a couple comments, but Alex, you want to throw in?
Yeah, and this may be the point where for Mark, then Mark's question, which I think you also alluded to, we can go to Michael's question, which is how can we steer the investments at a portfolio level, and how actually the selection process works in what we call the meta strategy. And here maybe quickly just as an intro, again, this is now the Markowitz plot here, risk return. You can see where our individual strategies are. If you have been using this tool, we've put online the portfolio builder, which again gives you the possibility of just making fixed weights.
Alex, let's just back up for, because we may have one or two people that have never really seen this before. So on the bottom is volatility. Now, volatility is often, but it's not the only measure of risk, but it's a good shorthand measure of risk. And it is looking at the up and downside bouncing around of the value of your holdings, right? So all else being equal, classic portfolio theory says investors don't like the stuff that bounce up and down. Now, it turns out real people don't mind it when it bounces up, by the way. They mostly mind it when it bounces down. And the bouncing down, just so you know, in technical terms, that's called a drawdown. So what we really focus on is drawdown management, but the normal classic approach is to measure it in terms of volatility, the bouncing up and down of the value of your holdings. And then on the left is simply compounded annual growth rate. So what you see at the very bottom, and Alex is doing the abbreviated version, but in his main presentation, he does a nice job of kind of building up to this, and you might want to show something there. But anyway, at the very bottom there, the lowest line, you see what the kind of, as Alex puts it, what the market gives you, which is kind of what bonds have been doing over the last, how many years is this, Alex?
7 years.
10 or so?
No, starting in 2008.
Okay. Yeah, okay. What bonds have been doing generally really well. What the stock market is giving you, okay returns actually. Both long-term bonds and stocks are actually relatively similar returns, but we know that they've been, they move around a lot more than most people prefer. We also know that there's some risk of some, at times, really significant pullbacks. So what we're doing is to say, how do you capture some of those returns, maybe even beat them, but by keep either the volatility the same and get better returns, or get decent returns but really move down on the volatility spectrum. And if you can get both better returns and lower volatility, that's kind of really magic almost. We're trying for that, which is how do you improve on both return and reduce volatility? Go ahead, Alex.
Yeah, thanks for that.
So I think
yeah, Mark, go ahead.
So I think the comment, what I heard was that, if I were to select just for speaking purposes, a target volatility of 20%, and the volatility of that mix of strategies went over 20%, then it's on me as the investor to perhaps at the portfolio level move to cash in order to control the volatility.
That's one approach, which is logical, so to speak. You can do that. You can attempt to do that on a timing basis. If it were me, I think it's more stable and reliable to do it at the initial allocation level. What does that mean? That means it says, okay, managing your life, managing investments, managing your wealth, whatever, how much risk assets are you comfortable having in the market versus how much you want in, essentially, theoretically, no risk assets. Now, we all know that cash is, in the long run, is eventually, it does have a risk. It's called inflation, right? And currency shifts, or CDs or whatever it is. And especially thanks to, our central bankers, they make sure that cash is like really kind of increasingly not doing anything. But nonetheless, that's the most important step. Now you say, okay, I could shift it month to month. 98% of humans, when they try to shift and adjust month to month, they screw it up, and they screw it up badly. And it has to do with the way our DNA is passed on from our ancestors, that we were, what fight or flight and all this kind of thing actually trains our DNA to be really bad investors. So most humans, when they intervene on a short-term basis, really do a lot more harm to themselves.
Mark, but going specific to your question, so each individual strategy does not go into cash to reduce volatility, but we use this mix of equities, risky assets, and bonds. Yeah. So that gives you a little bit a volatility cushion, let's say. Yeah, but you're right. If you would choose just a mix, for example, of two of our strategies and say this is kind of where my stomach, my gut still bears with me, then a fixed volatility or a fixed portfolio mix would just end up here. Yeah, there's no volatility control or volatility leverage month by month. If you want to do that, and this is exactly also what Michael asked me yesterday, then you would go to what we are just introducing, or about to introduce, which is what we call our meta strategy. And this would look, let me just go to the next slide, look like that. And I'm going to show you, for example, here. So at that level here, we say, okay, we take, let's stick with one example. We take three of our strategies, let's say bonds, global market rotation, and we take the maximum yield. Three underlying strategies, but now we do not do a fixed mix where each month you allocate 30%, 20%, 50%, but we apply a technical level and we say we want to dynamically change this allocation. Yeah, and sticking to the example Michael was referring yesterday, each month we want to select the top 2 out of these 3 strategies. Yeah, and in that case now comes what you were referring to, and we want to limit our volatility to be in each individual month not above a certain threshold. Yeah, that capability you were just referring to. If the volatility in a certain month goes above, let's say 10%, yeah, then you would prefer to move into cash. Yeah, but by doing that, by doing this dynamic weight in these meta strategies, you indeed then increase at the same volatility level, you increase by a couple of percentage points the return. Or if you want the same volatility, then you would actually, sorry, if you want the same return, then you would actually move over here and reduce the volatility. How does that work? And before I show you the example here, some of the methods or the rationale why we are introducing that. These meta strategies or portfolio of strategies, again, they dynamically change the allocation to individual strategies. Why? Because there might be changes in the market environment. Now, right now, the very much anticipated rise in the interest rates, there might be a change in the market regime that certainly, in a certain point of time, the market is going sideways, where some momentum strategies might just not be performing, or you also might have that certain strategies, because of the underlying mechanism, just stop working. Yeah, so this is the rationale of why we propose to pick there, for example, the top 2 out of 3 strategies. With that mechanism, we also introduce some knobs, let's call them, some features in the algorithm. Yeah, the most important, again, we can choose from different portfolio styles or different technical approaches, but we can also introduce what you were just saying, a volatility scaling. If the volatility passes a certain threshold, then we go into a risk-free asset. Can be cash, but can also be a bond. Yeah, and we also have in our modified Sharpe ratio what we call our volatility attenuator, which basically allows you to set how sensitive the strategy or the portfolio is to changes in volatility. Okay, and some other stuff we can go in later. Let me show you just an example. And this might be too small to read on your screen. But maybe let me still stick to that screen here. In this case here, we're using 3 underlying strategies. You just look at the color code. The red strategy is our bond rotation. The yellow one is the universal investments. And the green one is the maximum yield. That's exactly the example I just told you. So basically you invested in bonds, in S&P 500, which is the universal investment, and in bonds and inverse volatility, which is in the maximum yields. And here you can see exactly what you were mentioning. I'm setting here a volatility threshold of 10%. So I'm saying whenever the volatility of the combination of these strategies, so at the portfolio level, passes 10%, then I'm effectively scaling down. I'm not allocating 100% into these strategies, but I stay, as you can see here, 30, 40, up to 50% into cash. The time period was exactly 2008. Is that clearer?
Yes, that helps a great deal. Is this a tool that will be available at some point here to subscribers?
What
Yes.
you're looking at is QuantTrader, and so that is available now to a couple institutions, advisor groups are using it. But perhaps closer in for you, what Alex is talking about is, I mean, we basically have these developed already. They're working really well, etc. And that is when I say that which is working well, is we've used this tool, which is both an internal tool and an institutional platform that a few that are using right now, and we're kind of rolling it out to some, that to kind of build these meta strategies for you and make them available for your reasonably low cost, rent a strategy subscription. So basically, it allows us to have bleeding edge institutional level tool building that they're able to have these features when we build the combinations of our strategies together and run them and operationalize them. Does that make sense?
Yes.
So again, in that example, and I show you that in the next one a little bit bigger, 3 strategies plus the benchmark, using here technical level maximum sharp again, 10% volatility limit, we scale down. We use the bonds or the bond strategy as the hedge mechanism, which means we always have a certain percentage invested in bonds. You can see it never drops down to 0. This is one of the conditions. And here, in that case, we use monthly rebalancing, selection top 2 out of 3. And we also use, and Michael, that was another part in your question yesterday, we can also set a minimum and the maximum allocation, which in this case here I'm using 20 to 60%. Why is that? This minimum maximum allocation allows you again to avoid corner solution, where the algo by itself would move very drastically into 100% bond, for example, and the next month, because of something, might shift 100% into UIS. This might be, from a mathematical point of view or statistical point of view, beneficial, but again, it's a little bit against the human intuition. So we normally look for a little bit of stability, and we don't want to shift from 0 to 100%, so that 2060 helps to eliminate these corner solution.
So what you see in this graph, so the top graph, by the way, is simply the layers of holdings and their overall performance, and then the middle part of the graph is, as Alex pointed out, as you're shifting, and then you see areas where the bars don't go to the top, it means it went to cash to control volatility, and then the bottom, the black line, you can kind of see it's pretty damn smooth, not perfect, but compared to the market, etc., a nice upward slope, and that's what the goal is, and this stuff has been. And again, this is not magic in the sense of, and this is not like, oh, you're using some newfangled thing. This is actually the same techniques we use to build our strategies now. What it allows is a second layer, and the second layer is essentially goes back, is why Alex talks about Markowitz. If you look at a strategy as an asset, and just like as you blend assets together, Finance 101 is kind of like you have essentially a free lunch. You actually reduce volatility without giving up return when which is the basis of portfolio. It turns out that with the right tools, blending our strategies together does exactly the same thing. It essentially creates a free lunch.
If you look at that picture here, I received some questions. Why do we still have a relatively high drawdown of 15%? Isn't that high? That's also interesting. This is some of the, let's call it a secondary effect of the maximum sharp optimization we're using. If you look actually where this 15% happens here, and here again, this is the 2008 time frame. The portfolio or the overall strategy went fairly smooth through the financial crisis. Yeah, so there was no actually big drawdown. So where did this drawdown come? This is interesting. It actually didn't appear when the S&P 500 tanked, which is the red line. It happened when the bond started to give back in the January-March 2009 timeframe. Yeah, so that drawdown is actually not something where, let's say, on a longer time frame you lost equity, but it's rather, in my definition, a giving back a little bit of the previous gain. In technical terms, it's still a drawdown, but it feels a little bit different.
Right. Yeah. The more drawdowns are a big deal. When you're looking at a really long time frame, it's actually not the best way to judge risk is not a one-time drawdown, because that's like a one-time event. Not saying you should ignore the one-time event. What you should be more, if you want to diagnose and poke at something, I would urge you to look at and kind of look at both volatility as well as the frequency of the drawdowns. Over a year, over multi-years, whatever. Is what's a typical average drawdown? Is it a couple percent? Is it 5%? Do you have a whole bunch of 10% drawdowns? That is a better way as opposed to a one-time event over a 15-year time frame or whatever it might be.
We have a couple of questions here. For Michael, will there be leveraged and non-leveraged versions of the meta strategies? Yes and no. Yes, because we are going to introduce meta strategies which use, for example, the 3 times leveraged UAS, which everybody in a non-deferred account can normally trade. If you want to further leverage, then you can use a margin account or substitute an S&P 500, for example, by SSO, which would be the 2 times leverage version. Yeah. Leverage again.
We will take. Yeah. Sorry, we will take though. Look for feedback and thanks for the question in terms of whether we want to offer in the sooner rather than later a strategy that is structured intrinsically to use leverage 2x 3x assets to add to obviously, as Alex pointed out, anybody can always simply use a margin, put more capital into their trading account using that, but we will we haven't in some of these strategy variations, as and we will consider the merits of building a meta strategy that is all about using leveraged 2x types of ETFs. Go ahead.
And maybe he also has a general explanation. Here we're a little bit in a squeeze because of our structure not being a registered advisor. We're not allowed to do really a individually customized strategy. Yeah. On the other hand, obviously, we want to have or get a feeling of what is an interesting approach for a majority or bigger group of people out there. Yeah, and then we typically also would offer that solution. This is kind of the feeling we need to get and the feedback. And you have seen, normally we are quite responsive if there is a larger crowd of people saying, hey, we want to have a 3 times leveraged universal investment, then we launched it. And this was exactly what we did 2 weeks ago. Another question coming here from Stephen, is the meta strategy incorporated into the standard strategy alerts? Yes. So the idea is that in the beginning we would come up, or with this what we're just doing, come up with, let's say, 5 meta strategies, and then you just say, I want like number 3 out of 5, and for that you would get then the monthly trading signals.
Alex, you may want to go the next couple slides too, since people seem to kind of be really interested in the meta stuff. And they're such cool slides.
The next one is just another example, and here you can see the main feature here is I'm just using a higher volatility limit of 15% instead of 10. And here I'm just using 2 strategies. Yeah, and I'm saying I always invest in these 2, so it's not top 2 out of 3, but it's top 2 out of 2. But again, the volatility limit here also causes the portfolio going into cash in that case whenever the market is in turmoil. Interesting here is universal investment and maximum yield is an interesting combination because again it is US equities, S&P 500, it's inverse volatility of the S&P 500, SIF, being in the maximum yield, and in both strategies you also have long bonds, TLT or EDB. So just this combination of basically 3 asset classes works very nicely, even if you use a fixed rate portfolio. And you can see, without further constraining that, basically this portfolio stays mostly in a 50-50, 50% US, 50% maximum yield mode. It only deleverages and reduces exposure when the volatility is high. Yeah? And by doing that, you see how nicely the annual return increases with a Sharpe ratio of above 2. The drawdown is further reduced. And you see the volatility is exactly within the thresholds. Yeah? And here, this is volatility over the whole time frame. Again, in each individual month, yeah, the volatility again is limited to maximum 50%. I don't have the figure here how this would look like as a static 50-50 allocation, but it's definitely below that. So that dynamic approach adds additional percentage points of annual return. The third example, and I'm just scaling up here a little bit, let's call it aggressiveness. Here, I'm not using any volatility limit at all. And I'm playing much more aggressive also on the strategy. Oops. I'm using bond rotation, red, maximum yield, which again is inverse volatility. And I'm plugging in here, again, universal investment, but this time 3 times leverage version, so SPXL and TMF. Yeah. And this is again something which is definitely not suited for a, let's say, retirement account where you depend on your income, because it's really a very aggressive strategy. But just as a showcase, without or when taking out this volatility limit, over the last 7 years you would have had a compounded annual return of more than 50%, with a Sharpe ratio of above 2.2, and the drawdown of 27% again was in that time period when bonds were giving back. So even in the financial crisis, this very, very aggressive strategy or portfolio was going through smoothly. And then the last example we have, and this is now really a very, very crazy picture here, but this is just to show you also a little bit what we are working with some institutional clients. Sorry. This here is a strategy which basically combines sub-strategies of asset classes. Yeah, you can see here, red is a sub-strategy of developed markets, emerging markets, US industries, plus at the portfolio level we are adding individual ETFs, which is gold, futures in that case, inverse volatility, and TMF being bonds, long bonds. Yeah. This animal here contains us diversified over 40 ETFs, and in the case of gold, we're actually using futures. Yeah, so it's nothing a individual investor would do, because it's just too complex to have a portfolio of 40 ETFs, but it's the same mechanism and the same technology basically we're making available through the retail sector to the retail customer, individual customers, as we are doing for the institutional investors. Okay, then maybe let's do another round of questions. And again, feel free to either type them into the question box or unmute. Okay, here comes the question we feared all day by Michael. When will these meta strategies be available? Scott, I hand this over to you. No, the meta strategy really is something the four of us, we have been talking and had it on our list since mid of last year already, but really the implementation is much more, or was much more difficult than we actually anticipated. So we wanted to launch it already in the first quarter of this year, and now we're really a month in backlog already. Where we are right now in the process is the technology platform basically is working. So our current discussion is which meta strategies actually make sense for a broader audience. And again, the intention is that we first come up with 5, and our internal deadline is basically to have them available now in the month of May. And again, sorry if this has been postponed, but this is really much more complex than we thought. Any other question we could jump in? Or maybe let me go back to the agenda here so we can have a look at what other topic might be of your interest. Mark, here in this topic, the crash protection, here you find a lot of stuff why we are instead of going into cash like many famous authors do, we prefer to go into bonds. So instead of using a market timing like 200 days, yeah, as a reference, just Matt Faber does, we rather go then into long bonds. And the reason being, it actually, in our view, is a better crash protection, and it also helps you to get some additional. You actually benefit from these crisis points.
Yeah, as I've read the papers, it seems as if the papers indicate that once the correlation between bonds, or between the long bonds and the market, becomes positive, that would be the point at which you would shift to cash rather than the bonds, which are then more correlated to the market. As long as the correlation is negative, you stay with bonds, but then go to cash. Is that accurate?
In the long run, yes, but it depends upon how you measure the correlation. So there can be a lot of head fakes in terms of short-term changes in that, which will throw you off. So the trick is to give it some time, and the real trick objective is to set a firm rule to say, okay, here's the point where we need to say that the world has, and both looking backward and looking forward, has sufficiently changed. And that change would be indicative of, okay, the relationship of these assets is now entering into a different regime, and we need to look at things differently.
Mark, here in this slide, you can actually see how the correlation on a 60 days corridor was over the last, since 2006. So the correlation between S&P 500 and the different treasury bonds basically is stable negative. There are some moments like the famous Bernanke speech in May 2013 when suddenly everything flip-flops and within days things go crazy, the bond market, then the correlation actually gets positive. Yeah? But normally, and especially, and the point to highlight here is we're currently having a lot of talk and also a lot of questions. Hey, what is going to happen with the bond market when the Fed starts rising the rates? From an economic perspective or economic theory, yes, long-term bonds will then tend to go down, and especially the longer the duration is, the sharper they normally react to rising rates. But that's not our main point. Our main point is if you take equities, risky assets, and get into a crisis mode where suddenly equities start to tank, then whatever the duration is or whatever the level of the interest rate is, the money flows, the smart money and also the individual investors' money, they go out of equities and have to move somewhere. And that somewhere will still, in our conviction, be long-term bonds. Yeah, and that's exactly what you see in all of the past crises. Yeah. So even in a rising interest rate environment, which might come now, even if it's think it will be later and much more gradual than many people are talking now. The fear factor is actually what will matter in the next correction. Yeah. Then people will move into long-term bonds, and just by the demand, the yield will go down and bond prices will go up again. Yeah. So the mechanism, what I'm saying, the mechanism we are relying on is not the bond performance based on interest rates, but the mechanism we are relying on is the fear factor. Yeah, where does money flow in the case of a correction in the equity or risky market? And we say it's not cash, it's not gold or other commodities, it still will be in the future also US long-term treasuries. Is that point clear? Because it's one of the major discussions we're having with many people right now.
Yes, thank you.
Other thoughts and questions? Anything else we can clarify for you? Is there anything we didn't show you that you want to see, or any other thing about that maybe you're not comfortable with or doesn't make sense?
Or also anything which is not really related to this presentation, any question on the service you're offering, any feedback?
Yeah, if you have any suggestions on everything from the website to, anything now, or feel free to, if you've done it, and I think a number of you have, you'll notice that we do tend to answer your notes and emails quite quickly. Good. Well, I hope this has been helpful and valuable today. I think we're coming up on an hour, so we always enjoy hearing from you and talking with you, and hope to do this again.
And maybe also last point is, as you've seen, we're not really doing any marketing outside of the service we're offering. So if you like our stuff, then please help us in that, also spreading the word. Again, our intention is also to keep our overhead low, so you benefit from that. And by spreading the word, we get more people on board, and then can also share it with you.
Hey, I have a question real quick.
Yeah.
Just about, like, this is more of a, beyond the meta strategies. Do you guys have any other, I'm just curious, if you guys, like, have anything else that you're thinking about, ideas that you've thrown around amongst yourselves about where, where you might take it further than that. I mean, that's pretty cool. I mean, I'm just curious.
Well, we have a long list. Our problem isn't like, and I'll throw out a couple. Alex will throw out a couple. Our problem isn't like, do we have other ideas and things we want to do? Gosh, no. Our problem is
too many ideas.
How to sequence them and find time for them and everything else. I mean, there's so many ways to strive to extract an extra layer of value from this market. Matter of fact, Alex is astutely going to a page that actually talks to, one thing we're doing, by the way, is we're partnering with somebody, which this slide implies, in terms of a hedge fund, which may or may not be of interest to any of you. At some point, we may be launching an ETF. We have some partners interested in doing separately managed accounts. Put that aside. Also, this page actually refers to just a handful of the strategies that we have, which are pretty cool, that aren't on the website. You say, well, why aren't they on the website? Well, because we're trying to make sure that they're really stable, reliable, smoothed out. We can describe them to you in a way and support them in a way. I mean, we have some, for example, Dow and NASDAQ trading stuff, which adds value, that says, hey, what's the best Dow stock to own this month? What's the best NASDAQ stock to own, right? We have some things that go down to the individual industry level in the United States and say, rather than own the S&P, own the top 3 or 4 industry ETFs. We have more granular bond things. We have some stuff that combines gold into the mix under certain circumstances. That works really well. Wouldn't want to be long gold all the time, though, but when it's adding value, it's really adding value. We know how to do mean reversion really well, and sometimes that adds fantastic value, sometimes it doesn't. Mean reversion is the act of trading more frequently and fading the move of the market. Generally, it's been working better fading. What that means is, by the dip, in this case, historically, it may have meant shorting the market or taking money off the table when it went up too much. Generally, in the last few years, that hasn't worked as well, but buying the dip obviously works really well, and it works at the macro level. It also works at the individual stock level, and et cetera, et cetera. So I could go on for a long time. Alex?
Yeah, see, the feedback we are receiving so far is, or what our internal thought is, we are a little bit in a, let's call it, consolidation mode, where we say, let's focus a little bit of improving our processes to make it easier to invest in our strategies. Yeah, for example, we would like to give you the opportunity to pick a portfolio, save it at yours, and then you would get a consolidated signal for that portfolio instead of us sending you 8 individual signal emails. That's one point. Another way to make it easier, for example, as Scott just said, was to put an ETF out there, where you don't basically buy and hold this ETF, but the underlying, you have one of our strategies. So that kind of stuff, more to make it more convenient and easier and faster for you to invest. Yeah, and that's, I would say, definitely number 1 of our priorities right now. And then comes introducing the next couple of strategies, as Scott just said.
Thank you. I work in software development, so I understand you can do throw too much out there at one time and cause problems.
Hey, then
Hey,
drop us a line.
hey, Ben, do you want to? Yeah, you want to help us out? We could use another good programmer. You never have enough good programmers.
Drop us a line.
Tell us what you like to code.
Yeah, I don't know.
We understand. Well, if you ever,
Yeah.
if you ever change your mind, let us know.
All right.
Great. All right, last call for questions. Otherwise, we're going to wish you guys a wonderful weekend, and thanks for joining.
One more, if I could.
Yeah.
Yeah, within an IRA retirement account, I have access to options, but not margin.
Yes.
And I've asked the question on the blog, and I've seen some other traffic on the blog regarding options. You seem to generally have a pretty negative view on using options to implement these strategies. Could you just help me understand that a little better?
Well, I'll give you my perspective. Alex may have a different one. I have historically, and I still use options extensively. I've done a lot of modeling and testing on options. Options are great. You have to understand the difference between what you may hear on TV and what you often, but maybe not always, will read, versus what the research will tell you. What does the research generally tell you? Options are viewed as one of two ways. You have to understand where the edge of the option is. Edge meaning, I'll get to that in a second, versus how most people use them. The edge of the option, that is, where's the wind at your back, is actually not buying options. Not saying you can't make money buying options. I'm just saying when you buy an option, on average, most of the time, you are like the guy going into Las Vegas. Maybe in Las Vegas, not playing the slots, but playing, let's say, the roulette wheel, where basically, and I'm not talking about risk now, I'm talking about edges. You're playing against the house on average when you buy an option. So you better know when you're betting red that you better have a damn good edge, because guess what? The house is taking something off the top. Now, it's a longer discussion how and why. It has to do with basically the difference between implied versus realized volatility. And you're buying you're buying the higher price implied volatility, but you end up with is the realized opportunity. The difference is the premium you pay with options. When you sell options, you have the wind at your back. You are the house. You are the house. So options are fantastic leverage, are amazing leverage. So if you know that if you're going to be right, you want to be betting red, and you're pretty damn sure red's going to win, you're going to make a ton of money with options, right? I don't know whether red or black's going to win. I have no frigging clue half the time. I just know how to align myself so I have the wind at my back. And so I basically have done thousands of options trades, and almost the only time I'm buying an option is to close a short out. So that's just me.
Let me hop in. And Mark, maybe you have read the last thing I posted here in the board, also in the forum. We don't have a problem with options. The problem we have is it's damn hard to backtest a quantitative strategy using options. And really, there's nobody out there in the sphere who has a solid platform for backtesting a quantitative strategy over a long enough period using options. Yeah, and this is the reason. So again, our mentality or our philosophy is we're using quantitative strategies where no emotions are attached to, and we show why the approach works over a longer period of time. Yeah. So if we want to stick to that philosophy, we would have to really come up with extensive backtests why the same strategy works or even works better if we replace the ETF by options. Yeah. And this is really something where we have invested time in getting this done somehow, but it's not to a point where we say, yes, that's it. Now we can start giving you signals on an option. Why is that so difficult? It's because of options is exponentially more difficult because of all the Greeks you have in there than plain ETF. Yeah. There are some things in the forum you can see where we say, okay, if you want to invest in options and using the leverage, then you could go into certain in the money or out of the money options. And what we would do is kind of go into a strike price of 2 standard deviations away from where the market is. But it's not to a level where we really would say it's something where it's completely quantitative and we keep the human error and the emotions out of there. So that's really the main point. Does it make sense?
Yes, thank you.
There's another question coming from Stephen. Currency risk. Any thoughts or how your clients are dealing with that? So Stephen, can you give me, what's your base currency? Are you Euro, Asia, Canadian? Okay. Currency, you also see 3 of us, Frank, Vangelis, and myself, we are European, or me now a little bit migrated. So it's also a topic for us. Our general stake is, just because of the liquidity, it makes sense to invest into US exchange instruments. So we're also doing that, and then we are also exposed to the currency risk. Now there are 2 ways to handle that. We have done a lot of backtesting to use the same strategy and apply that in our case in Euro, using Euro exchanges and Euro-based ETF. One thing we notice is, just because of the spread, because of the execution, the liquidity, and also because of the still importance of the US dollar, it just doesn't work as well as if you do the same backtest on a dollar base. Yeah? So still our own, if we want to hedge the exchange exposure, then we go in with typically futures to hedge the exposure. Canadian, I think I just read yesterday or the day before also an article. It seems now that there are also, I think, US dollar based, Canadian dollar based ETFs with a similar or sufficient liquidity in the TSX. So you can try to just migrate, let's say, the ETF from the US dollar based to Canadian dollar based. Just make sure that they're using the same underlying index. This would be one option. The other option obviously is, as we are doing, stay in US dollar based ETF and then hedge using longer term futures. Myself, I'm using typically then at least 3, but normally 6-month futures. And again, Canadian dollar, US dollar is, again, from my perspective, at least less of a problem, because it's still relatively close in the range normally. It's still very much pegged because of the interaction of the economies, obviously. For us, euro based, or for Frank, Swiss franc based, you can see wild swings, 25%, and then with the Swiss central bank going crazy recently, it's really much more of an issue.
Good. Okay, another last call for questions. And gone. Okay, guys, thank you again so much. You know where to get us. Drop us notes, flowers, candy, it's all good. Appreciate you spending time with us here on a Saturday, and hope to hear from you and talk to you again.
Thanks a lot.
Take care.
Thank you, guys.
Bye now.
Out and over. Bye-bye.
Thanks.